Hello, hello, hello. We have one person joining so far. Spectacular. How's everything going? Can you hear me okay, by the way? Cool. So, because you are the only person to join so far, I'll just ask you. I mean, yeah, just ask me anything you want for sure. I mean, where are you from? I mean, I don't even. This is my first time recording this on YouTube, so I have no idea how to go about it. But if I'm sorry if I'm not doing things properly, but I imagine that I cannot see your face, right? I mean, I think that's not how it works. But and so yeah, if there is anything you want to ask me, anything you want me to cover, just by all means, yeah, just shoot it. Yeah, does that sound good? Fantastic. Awesome. So yeah, just take the time. You can ask me anything. It will be nice to understand a bit of your a bit about your background, but I'm not sure we can do that here, unfortunately, because if you're just going to have to type everything in, I imagine it's very time consuming. But anyway, it's just what it is. I'm actually surprised they don't allow screen sharing. I always like screen sharing whenever I'm talking to someone online, but I guess that's not how it works. So yeah, what's your first question? Cool. Go ahead. Okay, so my step-by-step valuation analysis. Very good. I There are different things that you can there are different ways to do this, but I really believe in simplicity when it comes to valuating a company. And so I like to use the DCF, and I believe you may have heard of it, right? So the discounted cash flow analysis. And then, so I mean, it's easy if I just share my screen to give you an example. And for example, you know that I've been an investor in you. I mean, if you've been following the channel, then I assume you already understand my portfolio holdings, right? Because I've always been very transparent about that. And by the way, I created that portfolio about 2 years ago, exactly because I wanted to make those to start a portfolio with real money, the company portfolio like a tortoise. And I wanted to be as transparent as possible. But over time, my intention is to allocate all of my investable funds into that portfolio because the framework is there and I do believe in it. So, but going back here to our DCF example, I'm going to do some screen sharing right now. So bear with me 1 second. Share screen. Can I do this? I want to share the entire screen. Okay, let's go for it. Okay, so what we have here, this is some of the companies that I've been following, but let's use, for example, Lululemon, which is one that you and I both know. And as you know, this is one of my holdings. So there are different ways you can go about evaluating a company. You can start, for example, with a simple DCF model. And for example, this model here, you can download DCF templates all over the internet. It's quite straightforward. But if you want this one here in particular, just let me know, and I'm more than happy to share it as well. But so, for example, how do I do this? So let me go here. I use stock analysis, and you can get access to this entirely free for free. And then I go here to Lululemon, and you can see that if I go to trailing 12 months free cash flow, which is the number we will be using, then you can see that the latest free cash flow is about around 1 billion. Now, notice one thing here. Typically, I like to see free cash flow and net income converging, but you can see that net income is actually much higher than the free cash flow. So you have to understand why these divergences are occurring. But I believe, well, based on my due diligence, this is because the company has been investing into they are opening new. Well, they are going internationally, as you know, so they have to open new stores, and they have been using a lot of that free cash flow to do so. Okay, but they are also buying back a ton of stock now that the stock has become very cheap. So the question is, which one should we use? Should we use the free cash flow or should we use the net income? You can use both. I will use free cash flow. Okay. And you can see that if I go here, that's the number that we see right here. Free cash flow in year one is about 1 billion. Okay. The current stock price of Lululemon is 209. So let's change that. 209. The perpetuity growth rate is the growth rate that you expect the company to grow after the 10-year period. And typically, after 10 years, the companies tend to grow at the same rate the economy does, which is about 3%. So I never change that. I just leave it as is. And then your desired return, this is where you will find me. This is where another way that I differentiate myself from many investors. Typically, they will choose, for example, 10%, but I always like to double my money every 4 to 5 years. And so I use 15% all the time. Okay. Now, what about the growth rate? This is the growth rate that that you expect the company to grow its free cash flows over the next 10 years. And I'm assuming 9%. Why 9%? Because if I go here to stock analysis and statistics, you can see that analysts are projecting, for example, 6.83% EPS growth for the next 5 years. Now, granted, free cash flow is not the same as earnings per share, but look at this. If I check the company's history, look at the growth of the free cash flows. Where is it? Damn it. This is actually operating growth rate. I wanted to check free cash flow growth rate, but let's have a look here. Look how nicely all these numbers have been growing over the last 10 years. For example, earnings per share, even the last 5 years. Look at that. Sales, earnings per share, even book value per share. Okay. And look at operating cash flow, 5 years, 29, 25%. So I think a fair number should be, for example, closer to 10%, even though the company has faced quite a few headwinds, as you know. So, but then that's the number that I will be using here. Yeah, okay, I think it's reasonable, and it's not that different from what analysts are predicting. So I just stick with that. And then what happens is, if you do that, you can see that the intrinsic value per share is about 108. So this means that if you assume that Lululemon can grow its free cash flows at 9% per year over the next 10 years, then the price you should pay, already with the margin of safety built in, of course, is around 108. Now the stock is currently is trading at double that, right? 209. So what that tells you is that this is probably too conservative, and probably free cash flows are not really realistic right here. Okay. Does that make sense so far? And then I will walk you through other example or the methods that I use to complement the DCF. Does that make sense so far? Are you with me? Awesome stuff. Fantastic. Okay, so let me continue. And now, for example, look what happened if I use free cash flows So I'm using free cash flows right here, as you know. Look what happens if I use net income instead of free cash flows, because net income, like I said, they have been investing a lot into growth. And in fact, if I go here to stock unlock, this is the only one of the few subscriptions that I have, and it's about $8 per month, I think, but it's well worth it. So if I go here to financials, look at the free cash flow, you can see, I mean, it's still very, very high. But let's use the trailing 12 months and you can see the decline. Exactly. So it's declined from a peak of 1 billion, almost 2 billion, to where it is right now, exactly because of all the reinvestments they are doing. So let's use net income and you will see that the intrinsic value per share will be higher, of course. So look at where is net income here? Earnings. Okay. Yeah, about this level. Look. Okay. So let's use that. If I go here to financials, let me change this to the trailing 12 months. And now let's use net income 1741. If I do that, 1741, look at that. Now you have an intrinsic value of around 167, which is higher because, of course, net income is greater than free cash flow. Okay, so you can choose one or the other. Choose the one that is more reflective of the company's like real value. So this comes back to understanding the business. If the free cash flow has been depleted because of investments, then it makes more sense to use net income, right? Because then if you are going to use free cash flow, it's understating the company's free cash flow levels. All right. So in that case, I would use net income. Or another thing that you can do is you can add to the free cash flows the growth capex, which is essentially the money that the company has been using to open new stores all over the world. And so I would go to the capex of the business. Look at that capex of the business, which is around 732, and look at the depreciation and amortization. This is typically is the maintenance capex. So what you want to do is, in this case, if you are going to use an adjusted free cash flow metric, you can take the capex expenditures, that's 73258. What? 732, 732, sorry, 732, yeah. And you can subtract the maintenance, depreciation and amortization is a proxy for maintenance capex. So let's subtract that, and you are left with growth capex. Now, this number, 237 million, is the number that you can add to the free cash flows. Okay. So that's another thing that you can do. Now, other methods that I use is, for example, I use the reverse DCF, and the reverse DCF will tell you what growth rate is currently implied in the stock price. Okay, so the based on this, if you use net income, this means that the intrinsic value is around $167 per share, right? But the company is currently trading at $205 per share, or 210. So the market is expecting superior growth here. So let's adjust the growth rate, and you will see that the intrinsic value per share will go up. So if I change this to 12%, look, 197. If I change this to 14%, 221. So we have to adjust it again, about 13%, bingo, $209 per share. What does that mean? It means that the market is currently pricing Lululemon as though the stock can grow, as though the company can grow its free cash flows by about 13% over the next 10 years. Okay. And so as an investor, now you have to ask yourself, okay, do I think that makes sense? Is that a realistic assumption? And if your answer is yes, then you could buy Lululemon shares today. Okay. And as you know, because I showed you the history of the company of the numbers, you can see that 13% is still very low relative to what the company has grown historically. But things have changed, and so I don't think this is going to be realistic. And I think you are far better assuming, for example, a 9% growth rate a 9% growth rate, like over the next 10 years, a compounded annual growth rate. Okay, so you have the DCF, you have the reverse DCF, and then what else do I use? Look, I attended Phil Town's Rule 1 investing workshop, and I learned three methods for valuing a business. And these, okay, about AVGO since earnings. Oh, okay, so this is another question. Let me just wrap up my thoughts here to conclude. So Phil Town, if you guys don't know Phil Town, just you can do some research, but you can look him up on Google. But he's quite famous, and he always uses three valuation methods when assessing a business, and so briefly, just to cover this, to touch upon this very briefly, one of them is the margin of safety. The margin of safety price is better suited for companies that are growing at greater rates, at about 15% per year. Okay, so these are companies that are growing very fast. They so and so if they are growing at about 15% per year, 20% per year, this is a very good method to use. In the case of a Lululemon, we are assuming 9%, right? So I mean, it's not really what it will do is it will give you a very low margin of safety price. Okay, how do I do that? How does this method of valuation works? Very simple. Let me walk you through it. You start with current earnings per share. If I go here to Lululemon, look, current earnings per share is 14.48. Okay. Then you assume a growth. The earnings per share growth rate in the past has been 20%, but analysts are assuming 8%. I want to be conservative, as I already mentioned, so I'm going to use 9%. Your default PE is double the growth rate, which in this case will be 18 times, right? Because you have to attribute a multiple to those earnings. I will, instead of 18, because the historical PE has been about 42, I think I'm okay with a 20. Okay, so and now this is so 20 is the multiple. So now what do I do? Look at that. You have to grow the current earnings per share 14.48 at 9% for 10 years. Let's do that right here. Calculate future value 14.48, right? 14.48, yes. Let's grow this at 9% over the next 10 years. Calculate, and we have 34.28. 34.28. And then you just multiply 34.28 by 20, and you get the future earnings per share. Okay? Now, this is the future. So if things go according to plan, each share will be priced at about $685 in the future. But remember, we have to discount those cash flows back into the present, just like we do with the DCF model. And because I always want a 15% return on my investments, you can just divide this number by 4. Okay, why by 4? Because at 15%, your money doubles every 4.8 years, which means that in 10 years you have so it's one double in 5 years, and it's another double in the other 5 years. So you divide by 4. Okay, that's how it works, and this gives you an intrinsic value of 171, but we never pay fair value. So we simply divide it by 2. Bingo, margin of safety price, $85 per share, which is well below the stock current price, right? Exactly. And that's why this one is not suitable because the company, it's only better for companies that are growing fast. So these ones are the ones that you should be using. I want you guys to tell me, are you with me so far? Does that make sense? Awesome. So let me just continue, and I will be closing my remarks on this shortly. The other method is the payback time. Very simple. Um, the payback time tells you, we think as business owners. So the payback time tells you how many years will it take me to take my money out of the business from current earnings or free cash flow, and you want that to be you want that to be 8 years or less, 8 years or fewer. So how the hell do I do that? You start it's so simple, it will blow you away. Take the last 12 months free cash flow. Yeah, we already discussed that is the number. And then you are going to grow those free cash flows at our growth, at our 9%, right, growth rate assumption. And you're going to do that for 8 years. As simple as that. And then you are going to add up all of those free cash flows, and it will give you about 13 billion. And then if you divide 13.5 billion by the number of outstanding shares, which is 120, you get 113. Okay. What does that mean? It means that if you bought the entire company today, if you bought the entire Lululemon today, and if the company could go on to grow its free cash flows at 9% per year over the next 8 years, then the price you should pay for the business would be around 130 $13 per share, because you want to recoup your investment in 8 years or less. Okay. But as we already discussed, Lululemon is investing a lot into growth. And so free cash flow might not be the best metric. So let's go and use the earnings per share. The net income. So you do the same thing. Okay. Then you sum. Why is this here? Hold on. Then you sum all the free cash flows from year 1 to year 8. Okay. And then it's we you do exactly the same thing. Bear with me. Okay. And then we just divide that by the number of outstanding shares. And now you have this divided by 120. You have about 174. Okay. So this is the number that I would be paying more attention to. Okay. So if you want to take your money out of the business from earnings, this is the price you should pay. Now, the last method is the 10 cap rate. And look how amazing look how amazing this is. So based on both these methods, you can see that based on the payback time earnings, right, and the 10 cap rate, the intrinsic value is, the margin of safety price to pay is for share is about 174. But let me explain this one here. The 10 cap rate is arguably the most conservative because it does not assume any growth rates. You start with operating cash flow. And if I can show you right here, let's go to cash flows trailing 12 months, operating cash flow 1861. Then you use total capex, and you want to exclude the maintenance capex, which is, you can, in the case of Lululemon, you can use the depreciation and amortization as a proxy, or typically maintenance capex is about 50% of total capex. Okay, so if that number is not provided, just do 50% of total capex. And then you are going to add the tax provision. How do I do that? Income statement. Tax provision is the same as is the same income tax expense, so 742. And that's the number that I have. 742. So how do you calculate on earnings now? You just do the operating cash flow minus the maintenance capex plus the tax provision, boom. And you are left with total owner earnings. And then if you divide owner earnings by the number of outstanding shares, you will get 17, you will get about $17 dollars per share in owner earnings. Now, you have to multiply this number by 10, and that will give you 174. Why the heck am I doing that? It's already right here, guys. This will drive what I'm trying to explain home. Look, in real estate, investors often accept a 5% cap rate, okay? Because this model was adapted from real estate by Philtown, meaning that property yields 5% of its purchase price each year before growth. Philtown uses a 10% cap rate instead because he wants to have a built-in margin of safety. So a 10% cap rate means the business generates a 10% pre-tax cash yield. In other words, you are earning 10% on your money and would recoup your entire investment in about 10 years, even if the business never grows. Okay, and this is the assumptions that this is why I really like this method, because it doesn't factor in any growth potential. So if you pay 174, it means that if you will be able to recoup your entire investment in about 10 years, if we assume if we assume operating cash flows continue to grow at about the same rate. Okay, so what's the intrinsic value of Lululemon? This is the price, the margin of safety price, and they all have a 50% margin of safety built in. Okay, and so by my assumptions, the intrinsic value is around $250 per share. Okay, 74, yeah, times 2, $350 per share, give or take. All right, and that's why I'm still holding on to my shares, because I believe the price is not. I believe you have a big margin of safety. Okay. So some of your questions: how are you feel? Okay, with you, are you using GAAP earnings or adjusted? Yeah, where can I get the sheet you use? I can share it. I can share it here with you. Well, actually, hold on. This sheet, I think I can share. So I can share the DCF that I'm using, but for the three models, the three methods, a very good way to do this is, let me continue to share. If you go to rule number 1, Philtown, right here, rule 1, many of these calculators, you have access right here, investment calculators. So look at this. EPS growth rate, margin of safety. Where is that? Sticker price. So margin of safety price is right here. Okay. So you just need to input your assumptions and it will give you the margin of safety price automatically. Always assume 15%, so this number doesn't change. And then what will change is the PE that you believe the company, the multiple they will have in 10 years, and the future growth rate, of course. So, and the other one is the payback time calculator, which is also here. So instead, it says EPS, but you can do either EPS or free cash flow growth rate, and it will give you the stock price. Okay, so all of this is quite simple. And then I just built those. I just built this here. So this is something that I just created from scratch and that I use for each and every one of my investments. And regarding your question, Felipe Pina, where are you from? Yes, I'm from Portugal. Yeah, I guess that's yeah, probably it's quite clear. Yeah, but so what I can do, guys, is I can share the DCF model here if you want, and you can then download it. But for the other methods, For the other methods, I mean, you have to be. I mean, I have to protect my intellectual property, as I believe you will understand. So I share them with clients, but you can build it as well. It's quite, and you will see me walk. Um, you will see me using them many times. It's very simple to use, but fortunately, you don't even need to build it because many of these calculators are already integrated into Phil Town's website. So it's quite easy to use, as I showed you. Uh, any books I suggest? Yes. I suggest, oh man, there are so many. Um, I think, yeah, I share the list. I always share the same list with even with clients. Okay, so the book, read everything that you can. Read Phil Town's 3 books. Margin of so let me share my screen. In fact, I'm already sharing it. Well, let me get rid of this. Phil Town's books. Um, and by the way, I'm talking about Phil Town, but I don't have any affiliation, no partnership with him. Absolutely not. But right here. But guys, I mean, the reality is that I think he completely changed my fortunes when it comes to investing. And at the end of the day, you have to invest in your own education. I've done many things over the years, and one of them was I do continue to do a lot of reading, but I also had to invest in courses. And but based on my own experience, I would say read these 3 books. Payback Time, rule number one, invested. Rule number one is the most important one, if I would say. Then do Payback Time and invested. And many people talk about the intelligent investor, right? I mean, we are all familiar with that one, intelligent investor. I like the book. I think it's not the best book if you are just getting started. If you are just getting started, you will find this a pretty much of a nightmare because the book was written in the 50s. It's very, I mean, Ben Graham, I mean, he needs 3 pages to say what he could have said in one sentence, and it's quite frustrating at times. It's a hard read, and but it's definitely, I think it's the Bible of investing, in my opinion. So you should definitely read it. Okay, so you have already these 4 books, and with these 4 books, I think you will be laying a very strong foundation, and then you will be ready to start at least considering investing some of your capital. But this is my personal, well, based on my own experience. Okay, but I read many books. In fact, what am I reading right now? Right now, I'm reading Peter Lynch. Hold on. I'm reading. I'm Portuguese, but I'm reading this book in Spanish because I lived in Spain as well. I'm fluent. Read Peter Lynch's books as well. One Up on Wall Street, very good book, very insightful. I learned that a lot as well. Thoughts on PGY and let's have a look at that. PGY. What's this? Okay, so it's already 11 o'clock, but I will do that for you. PGY. PGY. Let's see. Technologies. Is this a software business? AI. Okay. Okay. So my thoughts are many of these software companies got smoked because of AI, fears of AI disruption. And that's part of the reason why I try to stay away from software businesses because I just don't know what's going to happen. The company is primarily engaged in financial technology, fintech industry. Okay. Let's have a look at their financials. They get an insight score of about 3.5 out of 5, which is average. I mean, for a software company, I have to understand why this is not higher because they typically are very profitable. Okay, so share-based compensation. Oh my God, what's going on here? Let's see. No, P zero. When did they start? When was the IPO of this company? Okay, so the IPO date was 2022, not for me. Okay. I would say that I always invest in well established companies, at least require 10 years worth of financial data. Because if you are going to put your money in a company that is just getting started, you haven't given it enough time for the moat to build a competitive advantage. The question you need to ask yourself is what stops competition from breaching their moat, from disrupting the business? You don't see, so you only have a few years worth of data. It's not a well established company. Okay. So, in fact, they are not even profitable. I will never invest in a company that doesn't make money. Okay. These guys have been losing money. All right. So, try to find companies with solid track records and profitable companies. That's my understanding. Look, I've been compounding money at 30% for years. You don't need to try to invest in the next Amazon in order to make a lot of money. Okay. That's too risky, man. And the other one is AVGO. Let's have a look at that one. AVGO. Broadcom. Okay. Yeah, and thanks for sharing the ticker symbols, by the way. It makes everything a lot easier. Broadcom is a very famous company. This one, okay. Semiconductor, went IPO. So, I mean, yeah, I mean, there's nothing to say about this company except that the valuation multiple is just screaming high. I mean, look at that. I mean, this thing went ballistic. You have no margin of safety right here. I have no doubt that the company has great financials, profitability, management, growth. Let me have a look at the revenues. It probably checks all the boxes except for valuation. Look at revenue, CAGR 24% per year. I like that. Oh my, earnings per share, look at that. 32% compounded. Oh, this is I want to go back, say 2017. Yeah, not, well, that's staggering. So, I mean, yeah, let me have a look at one thing here as well. Cash from operating activities, fantastic. And what about, are they doing dilution? Free cash flows, ballistic. What about No, I don't want to see that right here. Depreciation, no. Stock-based compensation. Yeah, oh my, it's also going up. Let me check something. Metrics. What's the share-based compensation as a percentage of revenue? Yeah, I don't like that. I really don't like that. Share-based compensation. This is something that happens across the space. I don't like to see share-based compensation that is very, very high. I prefer cash incentives, and I can see that share-based compensation as a percentage of revenue here, 11% as a percentage of free cash flow is almost 30%. I mean, this is quite high. This is really, really high, and probably they flag that. Let me see. Actually, it's not flagged here, but I just don't like to see that. I just don't like to see that. But so even if he ticks all the boxes, and I assume he does, you have no margin of safety here because the premium. So the P is around 70, and the forward P is already 38. And in fact, if I go here to financials and go to metrics, like let's check the price to operating cash flow, for example, look at that. So it's the highest it's ever been going back to 2016. The same thing if you look at the price to earnings, it's at the highest level it's been since 2017, with the exception of 2024. You have no margin of safety. Okay. So my answer to that is keep it on your watch list if you really like the business and if you understand it, and then start calculating the intrinsic value of the company, and set it as a reminder in case the company. Remember, the semiconductor space is quite cyclical. Now they are going through the roof, right? Things are doing fabulously well, but at one point when the economy turns, this sector is going to be affected a lot, and that's when you should look at some of these of the most important names in the industry. Okay, that's my opinion. What else do we have here? Okay, trigger to okay on thanks. Let me see. On. What do they do? Same thing. So they went IPO in 2021. So I don't even have 5 years of financial data. So this alone would cause me to to stay away from it. But the other important thing is, do they make money? Let's start with that. So I can see that revenues are going up, of course, but what about earnings? Okay, so they have become profitable since 2021. That's already something positive. So they are profitable. They are probably in a growth stage, but I like the fact that they are not diluting a lot existing shareholders. Since 2019, the share count has only increased by about 1.42%. So I like that. Let's have a look at free cash flows. Exactly. Since 2022, they have also been going up. Again, the only problem that I have with that, Philip, I think, Philip, you asked me that, yeah, is what is their moat? Do they have a competitive advantage? What's going to stop competition from disrupting the business? Because clearly you don't have a lot of financial history. So, and that creates a lot of uncertainty. And on top of that, I can see that the multiple is, I mean, it makes sense to be 30 because this thing is just yes, it is quite recent. So investors are assuming further growth. That's fine. The market cap is already around 16 billion, though. Let me have a look here. Something. Metrics. Yeah, look at that. I don't have enough data. I don't like that. I really don't like the fact that I don't have enough data. I would just stay away from it. Demand at least, I say 7-10 years of financial data. I never invest in a company with fewer than 7 or 10 years of financial data because I like to see that the company has already proven itself, and you can make a lot of money doing that. I run a concentrated portfolio of only a few companies, and so if you this is where it comes down to your approach to investing. So look, what does it fit your style? What does fit your style? So are you someone willing to spread yourself across 15, 20 names? And if that is the case, then you can afford to have one or two speculative names in your portfolio. I don't do that. I run a portfolio of 6 or 8 companies at any given point in time. And so I prefer well-established companies, right? Well-established companies with a big margin of safety. And you do that consistently, you can make a lot of money. And that fits my style. It fits my framework, and it aligns with my long-term investing goals because I want to double money every 4 to 5 years, and I'm well above that. So it comes down to understanding who you are as well. I will not invest in these businesses because I don't see predictability. I want big moat companies. Okay, so I hope it makes sense. And okay, man, I love the fact that you guys managed to join. I can take one more question before leaving for lunch with family because I'm in Portugal right now. And I will be here until beginning of until the end of December 27. Then I will be back in London. Is there anything else that you guys want to ask me? I can take one more question. And I do hope that you managed to make the most of it. I certainly enjoyed it, and I want to do this more often. Yeah, I'm more than happy to take one more question from you. And let's see what you share. If you have something to share, of course. Meta with their capex on AI. Meta. Meta is a business that Meta is a fabulous business, and there are many things that I like about the company. Number one, they have the strongest. There are different types of competitive advantages, but the strongest of them all is network effects. Network effects means that the more people the platform has, the stickier it gets, and the more difficult it becomes for customers to actually switch to another company, right? Network effects. Meta has that. Think about how many people they have across WhatsApp, Instagram, Facebook. They have such a big moat. Skin in the game. So the CEO, Mark Zuckerberg, founded the company and has a lot of his wealth tied into the business. I love that. So the only problem that you have with Meta is the current valuation. Meta is a company that you should have bought when after that big. I mean, this was a screaming buy. This was a screaming buy when the stock crashed 75%. And by the way, so many of you are saying, but the company will never crash that much. Look what happened in 2022. They crashed 75%. Okay. So no matter how great the business is, they go through periods of uncertainty every now and then. And this is when you should attack. Not when everybody's propping up the stock price. No, only when there are doubts surrounding the business that are not going to create structural problems for it. What was the cause of this big decline? They were spending a fortune on metaverse, and investors got spooked out of the company. But if you looked under the hood, there was nothing wrong with the company from a fundamental standpoint. And it's similar to what we are seeing right here. The company declined some 25% because they mentioned that they will be spending around over 100 billion, right, in capex for AI this year and next year. And they have no clear product. They have no clear path to profitability, and so it's like shooting in the dark. But all these AI players are doing the same thing, and it remains to be seen whether this is going to create any real value. But that's what caused investors to be spooked. But that said, the stock hasn't come down enough for me to get interested. But let me know if the stock ever goes down to say 370, and that's what I will be very interested in buying. And I mean, it's just what it is. Okay, if you get one of these things with a big margin of safety, you're gonna make a ton of money. People who bought Facebook at $80 per share, are you serious? They made a ton of money, and it's how you can make a lot of money as well. And so whenever you hear people, investing is risky, not necessarily. It depends on the framework that you are using. But if you buy a well-established, high-quality business with a big margin of safety, what happens is you are cushioned against downside, right? Because you are minimize your losses while maximizing your upside potential. And yes, I am in. Right now I'm in Portugal, but I will be in London from December 27th. But right now I'm still in Portugal, and it's always nice to come back home and see and get to see closest relatives and friends. You bought at 485 and doubled down at 585 on the recent dip. I hope it goes well for you. The good thing about Meta, like I said, is that they have one of the best CEOs in the world, and he has a lot of skin in the game. And he's young. He's still going to be at the helm of the company for many years to come. And so I think they're going to continue to create a lot of value over time, even if the stock goes through periods of uncertainty. And if you look at the track record, they crash 50% on multiple occasions. That's when I would be more interested in attacking them. But yeah, I think you have a good investment over time. Uh, cool, guys. I mean, thank you so much for joining, and let's do this. If you want to do, I'm thinking of, shall we do this? Say, I don't know, once a month. Is it once a month? We can just try it out and see how it goes. Hopefully, we'll have more people joining. But if you like to just share it with other people, and I'm going to try to continue to deliver as much value as possible. Okay. Thank you so much for everything. You guys have been amazing. I've been reading all your comments, and that really is awesome. It means that I'm see maybe I'm just sharing some value. Okay, so yeah, thank you so much. Have a great rest of your day. Yeah, exactly. The more subs you will get. Yeah, so we will see. For Greg's. Okay, cheers, guys. Have a great day.